We go to chapter 11, year-end adjustments. When we talk about year-end adjustments, it's simply talking about things we have to do before preparing our financial statement, before getting to the statement of financial position. So, because most of the time, there are items that we have paid for or we have received from, maybe we have received certain amount of money from customers that they don't need the service or the goods now. So all those things has to be taken away. If not, we'll be overstating our profit or understating our expenses. So we need a balance. We need to prepare our statement of financial position and statement of profit or loss with fair information, so that we don't mislead we don't mislead users of our accounts. That's why we need to check our year-end adjustment. We need to make adjustments. So I wrote, there are several reasons why a business may need to make adjustments to their accounts at the end of the year. One, the expense and income item shown in the cash book may not be the amount of income and expenses to be reported in the statement of profit or loss and other comprehensive income. So it means the total amount of money you've made, the total income in your cash book, you might not have to record all in your statement of profit or loss and your statement of financial position. And total expenses you have incurred, you might not have to record everything in the statement of profit or loss or statement of financial position. So you have to make adjustments. That is why we need adjustments. So the adjustments are important as financial statements are prepared following accrual concept. And we know what accrual concept is about. The revenues and costs of this financial year must be recorded for this financial year. So here I wrote, the adjustments are important as financial statements are prepared following the accrual concept, which means revenues and costs are recorded in the period that they are incurred, not in the period they are paid. So it is not when we make the payment. In as much as we have incurred it, it means we have accepted the liability. So it has to be recorded. Do you get the point I'm making here? The point is, you have incurred some cost. You have made some money. So in as much as you have received those amount of money from your customers, it means that you have accepted the liability. And if you have made a payment to your supplier, it would have meant that your supplier has accepted the liability too. So whatever we have done, it has to be accrual concept, which means in as much as we have incurred that expenses, it has to be recorded in that period, not when we are paying it. We might pay next year, but in as much as we have accepted the liability, it has to go with our account preparation. Is it clear? Is it clear, please?
Yeah.
So that takes us to the categories of adjustment we have. So we're going to start with accruals. For accruals, it's an income or expenses owing this accounting here. The amount of money we are owing, or the amount of money the amount of money that we've received from our customers for goods that have not been paid for. So we call it accrual. So this is the income or expenses owing in this accounting year. So the amount of money you have received for service that you have not rendered, or the amount of money you have paid for services that you have not received. Now, so let's put it this way. The amount of money you have received for services that you have not rendered is an accrued. Because you have received the money, it's a liability to you now.
Yeah.
Or the expenses that you have incurred that you have not paid for. Did you get it now? So it's accrual. You've been serviced, but you have not made the payment. It's accrual expenses. Or you receive money from your customers for the service that you have not rendered. It's also accrued income. You get it? So accruals has income and expenditure. Do you get the point I'm making here, please? So for accrued expenses, it means expenses that have been incurred but not yet recorded. You have incurred these expenses but you have not recorded it. That is accrued expenses. Then we have accrued income. The income due to the business but not yet been recorded. Your customers are owing you for the service. Now it's accrued income because the income is supposed to come to you, but it hasn't yet. But since in as much as your customer has accepted the liability, then you have to record it. So accrued incomes are income that is expected in the business. Accrued expenses are expenses that has been incurred by the business.
Okay.
That has not been paid for. Clear. So for accrued expenses, what do you do with accrued expenses? All expenses are recorded at the accrued, and the accrued will have a credit balance in each individual account. So your statement of profit or loss account will have a credit side. So it's accrued expenses. So you have to take it away from the expenses. Do you get the point or not?
Yeah.
The amount, it has to be on the credit side of your statement of profit or loss, because it's an expenses, right? Statement of profit or loss will have the credit side, and the balance on the credit side will be balanced brought down on the credit side of the individual account. That is for accrued income, accrued expenses. For income, these are amount of money that you are expecting to get from your customers, but you have not gotten them. So to be on the debit side.
Okay, so the money that your income.
It's your
expected to
income,
come
it's
back.
coming in, but it's not yet in. So it's going to be on the debit side. Do you get it now? So here I wrote, all incomes are recorded and the accrued will have a debit balance. So if it's accrued expenses, it's going to have a credit balance because you are owing. If it's accrued income, it's going to have a debit balance because you are going to receive it. Here you are paying out. Here you are receiving. So accrued expenses will have a credit balance. Accrued income will have a debit balance. Is it clear? Is it clear, please?
Yeah.
So for accrued expenses, the amount accrued will be recorded in the statement of financial position as liabilities.
Okay.
That's other payables. In your current liabilities. You know, there's trade payables. These are the amount of money you are owing to your suppliers, different.
Yeah.
But here, you have incurred expenses, but not yet paid for them.
Okay.
So it is other payables.
Okay.
Do you understand? So it's going to be in your statement of financial position as current liabilities.
Even trade payables and current liabilities.
Yeah. There's difference between trade payables and other payables.
Okay.
Other payables are that amount of money, that expenses that you have incurred, but you have not paid for.
Yeah.
You have not yet recorded. So it's going to be under the current liability, under the current liabilities as other payables. Do you get that? Therefore, accrued income, the amount of accrued will be recorded in the statement of financial position as other receivables.
Other receivables.
Yeah, because you are expecting that money to come in.
Perfect. So one is other receivables, one other payables.
Accrued expenses, other payables. Accrued income, other receivables. So it will be part of your current accounts, current assets.
Yes.
Accrued income is a current asset. Accrued expenses is a current liability. Clear? Are you sure?
What again, Mr. Current?
Accrued expenses.
Yeah.
These are the expenses that you have incurred that you are not yet recorded.
So they're current.
They are current liabilities.
Current liabilities.
Accrued income, the service you have rendered to your customers,
Yeah.
that they are not yet paid for it.
Mm-hmm.
It's going to be part of your assets, just like your closing inventory.
Oh yeah, Mr. Yeah. Trade receivables is in non-current assets.
Current
Current
assets.
assets. Current assets.
Same as your closing inventory. Your closing inventory is the inventory you are closing with. It will be part of your statement of financial position as current assets.
Mr. I'll trade it. I will use it like trade receivables, trade payables. Same thing.
Yeah, but you write receivables, other receivables, other
not
payables.
Yeah.
Is it clear? Is it clear, please?
Yeah, yeah.
So that's about the difference between accrued income and accrued expenses. For income, I explained it, right? The income will have a debit. So the statement of profit or loss account in the income in the individual account will have your statement of profit or loss to be on the debit side for accrued income.
Yes.
Accrued income will have the individual account.
Yeah.
Because it's an accrued income, it's going to have your debit, your statement of your statement of profit or loss account will have a debit entry. But for accrued expenses, your statement of profit or loss will have a credit entry. Clear, right? So that takes us to
Prepaid.
prepayment. Are you there? So for prepayment, it simply means the payment in the current period for goods or services to be received the next accounting period.
Okay.
So it's a payment
Of goods that are going to receive in the next.
that will be receiving the service in the next accounting period.
Like prepaid, like
Prepayment,
pre-rent.
yeah. So for prepayment, we have prepaid expenses, just like accrued, that we have accrued expenses, accrued income. Here we have prepaid expenses and prepaid income. So what makes them different?
Mr. How do you debit or credit prepaid money? And
Yeah, they go into your statement of financial position and you take them away from your statement of profit or loss.
Okay.
If it's prepaid expenses,
Yeah.
because it's prepaid expenses, you take it away from your expenses
Away from.
and it goes to your asset, your statement of financial position. If it's prepaid income, it's an income, but that income, it's not for this accounting year. You take it away and it becomes a liability in your statement of financial position because it's not your money.
Yeah.
It's debt to the third party.
That's a third party.
Do you get it? I'm going to explain it here anyway. So prepaid expenses, these are future expenses that have been paid in advance. So we call it advance payments. So the amount must be taken out from the expenses. Yeah, you paid it in all, but you have to take that amount away from your expenses.
Total expenses.
Like maybe you have your rent to be 5,000 and you're told that there's accrued rent.
Mm-hmm.
You had it.
Yeah.
Prepaid rent, you take it away.
Perfect.
Is it clear?
Yes.
So the expenses in the statement of profit or loss, that means you have to take it away from the statement of profit or loss and other comprehensive income. So the amounts taken away from the will become the current assets, which is other receivables. For prepaid expenses you paid ahead of time, right? It is part of your current asset. It will be called other receivables.
Other receivables. Okay.
Do you get it? Because you have paid. So it's the business that is your supplier that is owing you. So it is an asset for you. If you are owing your customer, it's a liability. But if your customer is owing you, it's an asset. Okay. Just like if you are owing your supplier, which is other payables, and now your supplier is owing you, it is other receivables.
Okay.
Is it clear? Then for prepaid income, this is the revenue which has been received for goods and services that are going to be provided by the business in the future accounting period. So prepaid income will be deducted. Again, you have to take it away from your income. Yeah. Because it's not all the income. That's why we need adjustment. Perfect. So prepaid income will be deducted from the accounting year income in the statement of profit or loss account and will be recorded as liability in the statement of financial position as other payables. Okay. Is it clear? So that's the difference between prepaid expenses and prepaid income. So that takes us to provision for depreciation. So for provision for depreciation, and we have, okay, it's just about the explanation. Okay, are you there? For provision for depreciation, I wrote the figure used in calculating we know depreciation anyway, so we would have calculated our depreciation using maybe straight line method or reducing balancing method. Whichever ways, as soon as we're done, the amount we have goes to our trial balance. So the amount in the trial balance is how we prepare it's what we use as a provision for depreciation. Done. Then we go to irrecoverable debts and provision for irrecoverable debts. So there's a difference between irrecoverable debts and provision for irrecoverable debts. Provision for irrecoverable debts is the same as allowance for irrecoverable debts. We are making provision for it. Yes. It's different from what is certain. So for irrecoverable debts, the difference between them is this. Irrecoverable debt is certain because you wouldn't have said it's irrecoverable if it is not. So that is certain. Yeah. So the double entry for irrecoverable debt is that you debit irrecoverable debt account and you credit trade receivable account because that individual is not going to pay anymore. Yes. You are paying. So you just assume he paid or she paid. So you have to give it a credit and you debit irrecoverable debt account. Yes. Because it is certain. So irrecoverable debts are certain, which means our double entry will have the debit you debit irrecoverable debt account and you credit trade receivable account. Done. Clear. Now for provision for irrecoverable debt, it is not certain because you don't know the total number of customers that will not pay back. So it is not certain. Yeah. So you are making the provision for it in case the debt goes bad. If the debt goes bad, it becomes irrecoverable debt. Yeah. But in case the debt goes bad, that is the provision we are making. Yes. So the provision for irrecoverable debt is a provision because the provision cannot be certain that all the outstanding values of trade receivable, that's credit customers, will be received from customers. You don't know that if they are going to pay or not. Yes. So the double entry is this. So if your provision is increasing, that means you are having more provisions. You are making more provisions. So that means you have to debit provision for irrecoverable debt account in your statement of profit loss account. You had it. You add it to your provision, the provision you have made. Yes. Then in your statement of financial position, you have to credit it. You have to take it away. Do you get what I'm saying? You know, you have your trade receivables. Yeah. If you are increasing if your provision for irrecoverable debt is increasing, if it is increasing, that means you debit it in the statement of profit or loss, it has to be on. It's an expenses.
Yes.
Because it's an expenses there. For your irrecoverable debt, you credit it, you take it away
Correct.
in your trade receivables in your statement of financial position.
Statement of financial.
So that's why most of the time when it is irrecoverable debt, as soon as the debt has been, as soon as it is irrecoverable, you take it away from your trade receivables. You minus it because your total number of trade receivables has reduced. Do you understand the point? That is what happens here. So provision for irrecoverable debt statement in the statement of financial position will be credit. You minus it.
Yeah.
Then, if it has decreased, if the provision you are making for this year has reduced, if it reduces, in your statement of profit or loss, it will become an income, operating income. If it is increasing, it's an expenses. So if it is reducing, it becomes an operating income. You add it in your gross profits.
Okay.
Do you understand? It's part of your. Do you get it or not? If at the end of it all, you find out that the provision you made for your irrecoverable debts is reducing. That last year it was 500, this year it's 400. The difference is 100. That difference you add it as an operating income.
Operating income.
Just like commission received or discount received.
Okay.
You add this as an operating income.
Yeah.
So in your statement of financial position, it has a debit. You add it to your trade receivables.
Yeah.
Then you take it away from your statement of profit or loss because it becomes a credit entry. We are still on increasing, right? If it increases, it's an expenses for you. It goes to the debit side of your statement of profit or loss.
Yeah.
In your statement of financial position, it's going to be on the credit side, which means you have to take it away from your trade receivables.
Yeah.
On the other hand, if it decreases, it becomes an income for you.
Yeah.
Because it's an income for you, it's going to have a debit balance in your statement of financial position. It's an asset now.
Okay.
Do you understand? But in your statement of profit or loss, you have it as what? An expenses. It has to be on the credit side, which is an income.
Okay.
The debit side, now it's going to go to the debit side of the statement of financial position, and it's going to have a credit entry in your statement of profit or loss, because the credit side of your statement of profit or loss is income.
Statement of profit or loss, the credit side is income.
Yeah, income. Gross profit,
Gross profit income.
add income, operating income, other receivables, other rent income, commission receipt,
Yeah.
they are all income.
Yeah.
So your statement of profit or loss will have a credit entry. Your statement of financial position will have a debit entry.
Okay.
Do you get it? But if your provision is increasing, it's an expenses. It's going to have a debit entry in the statement of profit or loss and the credit entry in the statement of financial position. So that ends the difference between provision for depreciation and irrecoverable debt. Yes, we explained it.
I know.
So we'll be going to the activity.
You have to do activity from